Welcome back everyone to our Thursday Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and today we're going to be talking about one strategy that you can use in your portfolio to help you generate consistent income and grow your trading account. I would argue that whether you're new to options trading or you're an experienced options trader, this is the one strategy that everyone should be familiar with and understand how to utilize in your portfolio if you are interested in generating income and growing your account in a consistent manner. It's a strategy that has limited risk, limited reward, so it's suitable for all experience levels. It may seem a little bit intimidating at first, but that's why today what I'm going to do is break it down for you so that you understand how the strategy works and, more importantly, when and how to find the best opportunities in the market. Just as a reminder, what we do here on Thursday afternoons is our options education sessions are focused on helping you become a sustainable and confident investor so that you can grow your accounts in the long run by providing you a well-rounded education for trading options. That means covering everything from technical analysis to fundamentals analysis to option strategies and risk management so that you have everything that you need in order to consistently grow your accounts in the long run. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using during today's session. So as a reminder, what we're going to start off with is showing you kind of what it takes to actually grow an account, especially if you're brand new to options trading or if you find yourself struggling with growing your account. Let's talk a little bit about what are the foundational elements that you need in order to grow your account in the long run. Then we're going to talk about the simple and forgiving option strategy. It's a single strategy that I think everyone should be learning to master and understand why the strategy works and how it can be utilized in your portfolio to help you grow your trading account. We're going to go through a live trading example so that it breaks down exactly the trade and how to actually execute the trade and understand, more importantly, why this strategy can give you an edge, how and why it can give you an edge. And then I'm going to show you how you can access real-time trading signals using this specific strategy on the OptionsPlay platform, going through some of the examples before we open this up for Q&A here at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you generate consistent income in the markets using credit spreads, which is a strategy that we are going to review during today's session. So let's start off by talking a little bit about just what does it take to grow your trading account? Now, a lot of times I get questions from investors asking us, are these sessions recorded? Can I get access to the slides? And the short answer to your question is yes, you can get access to all of those. We post this onto YouTube every single weekend after the sessions so that you can get access to the recording and the slides. But during today's session, I'm going to be showing you the OptionsPlay tools, specifically how you can find trading signals for the specific strategy that I'm going to show you during today's session. And in order to access that tool, you either have to have a membership. So for those of you that currently already have a membership, thank you so much for your support and allowing us to continue to do this. If you don't have a membership, if you don't have a free trial, you can sign up for one for 30 days completely free of charge without a credit card by pointing your phone to the QR code on your screen or simply clicking on the link optionsplay.com/sign up. That will take you to a free trial sign up. It takes literally 10 seconds to get started. If you can point your phone into that QR code, that can get you started right now. And that will give you access, like I said, to the recording, the slides, as well as the tool for free for 30 days so that you can test out our trading signals for credit spreads and see how they perform. So let's talk a little bit about growing an options account. You know, this is for those of you that are either new to options trading or at this moment you're still struggling with consistently growing your account. What does it take to actually get there? Number one, you need to gain some confidence. You need to understand why a strategy works. I see a lot of traders that trade strategies simply because someone else told them to trade them, or they're trading a strategy because someone else taught them the strategy. And the problem there is that Many times, if you're just following what someone else is doing without understanding the strategy, the second you go through any string of losers, you jump ship and you try to do something else. And the reality of trading is that no strategy is prone from going through a series of losers. Every single strategy at some point will go through a series of losers. And if you don't understand the strategy, you lack the confidence to push through those series of losers and continue trading and get yourself back on the other side of things. So understanding the strategy fundamentally is incredibly important. That's one of the key things I want you to be able to get away from today's session, is why this strategy gives you an edge, and why even when you go through a string of losers, you should continue trading it so that you can come out the other end. Second thing that I think is important is gaining consistency. And this comes down to winning more than 50% of your trades. If you can win more than 50% of your trades, you tend to have the energy to want to invest your time and efforts to optimize and get better at trading. Can you make money by winning only 30 to 40% of your trades? Absolutely. And many professional investors do, because they trade higher risk to reward strategies. They don't win very often, but when they win large amounts of the premium that they've paid. However, those types of strategies, I tend to find that especially beginners struggle with only winning 30 to 40% of the time and finding the energy and the time to continue to invest and improve their trading. So the strategy I'm going to show you here today naturally will win more than 50% of the time right off the bat and get you kind of over that hump initially. And third of all, preventing blowups. This is really key for anyone who's struggling with growing your accounts, is how do you prevent account blowups? So the strategy we're going to go through today, you have limited risk and limited reward, which means that you know exactly how much you can potentially lose before you get into a trade. So you have zero excuses, so that after you get into a trade, you say, I'm losing too much money on this specific trade. Because if you're losing too much money on a trade, the only person you can blame is yourself, because what that means is that you traded too many contracts when you got into that trade. You can calculate exactly how much money you can potentially lose on a trade prior to getting into a trade. So if after you get into a trade, you find yourself losing quote unquote too much money, you have to go back to how many contracts did you trade and trade the appropriate number of contracts, so that next time around, even if you lose 100% of the max loss of that specific trade, you're well within your risk tolerances to continue trading. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about credit spreads. Why this is the one strategy that I think, whether you're a beginner or an experienced trader, you should learn to master if you're looking to grow your trading account. So a credit spread is an income generating strategy. It's generally suitable for when you have a mild directional view on a stock or ETF. What that means is that simply if you can basically look at a chart and generally see that it's drifting in one direction or another, that's all you generally need in order to potentially trade that underlying security. You don't necessarily need to know where you think the stock's going to go. You don't necessarily need to have a fundamental view or necessarily even a strong technical analysis understanding in order to trade these types of strategies. If you can look at a chart and generally see that a stock is drifting in one direction or another, that's enough as a starting point to potentially trade it. It's also a forgiving strategy. It has naturally a higher probability of profit, so you're going to win more than 50% of your trades right off the bat. And it has limited risk and limited reward, so you know exactly how much you can potentially win or lose on a given trade before you get into that trade. So you can calculate the right number of contracts so that no matter what happens, you know what your best case and worst case scenario outcomes for each one of those strategies are. And that's why credit spreads, in my opinion, belong in every portfolio for options traders. So let's look at an example here. As I said, the only thing you need is a basic view of a chart. As you can see, if I'm looking at a chart here, the stock is generally trending higher. That's a potential opportunity to take a bullish credit spread. So let's lay this out. I'm looking at Alibaba. It recently broke out above that $80 level. It's trending higher, starting to trend higher here. This could potentially be the candidate for a bullish credit spread. So I'm going to walk you through the construction of this credit spread right now, and then we're going to come back to understanding why I chose these specific expiration dates, strike prices, and the construction of the trade. So at the time, Alibaba was trading at about 82 and a half or so. What I'm doing in this particular case is I'm going to sell an at-the-money put option, an $82 put option, and I'm going to go out to the June 28th expiration, which is roughly 45 days from expiry. I'm sorry, it was at the time 36 days from expiry. So I'm going out slightly higher than 40 days from expiration. And what I'm doing is I'm selling an at the money put. So in this particular case, by selling that at the money put, I'm collecting $3.14. Now, for those of you, if you're familiar with selling a put or a naked put, what you're doing is you're effectively betting that the stock is not going to move lower, that as long as it stays where it is or moves higher, you'll be able to collect the $3.14 credit on this short put. However, when you sell a short put, there's two things that I think is challenging, especially for those of you that are new to options trading or if you have a small account, because selling a put requires a huge amount of margin to trade and you're taking on substantial amount of risk, the same risk as buying the stock outright. So that's a risk that perhaps you're not willing to take, and perhaps you don't have the margin requirements to hold on to selling a cash secured put. You need about in this particular case, nearly $8,000 in cash to sell one contract, not something that everyone has, which is why we're turning to a credit spread. But when you're trading a credit spread, what you're doing is instead of just selling the $82 put, you're going to buy a lower put against that. So in this particular case, let's say we buy the $77 put, but pay the $1.10 for that. And what that means is that instead of collecting $3.14 for it, I'm going to pay $1.10 for the $77 put. So my net credit on this specific trade comes down to $2.04. So instead of collecting $3.14, I'm collecting $2.04. So I'm collecting a little under $1 less than what I was doing before. But the amount of risk that I'm reducing the trade by and the margin requirements that I'm reducing it by are astronomical compared to what I'm giving up in terms of income. I'm giving up about $1 worth of income, but if you look at my maximum risk here, it's $296 on this specific trade. Before, I was risking roughly $8,000 on this trade. Now I'm reducing my risk to only $296 in exchange for buying that $77 put. So by collecting $1 less, I'm reducing my overall risk here by over $7,500. And that means that in terms of margin requirements, I only need $296 per contract in order to in order to trade this strategy instead of the $8,000 that I need in terms of margin requirements to trade this strategy. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So right off the bat, what you're able to do is basically have a very similar risk profile to selling a naked put, which has many advantages, and we're going to talk about what those advantages are. But you don't have any of the disadvantages of selling a put, which is high amount of risk and high amount of margin requirement in order to get into it. And that's why credit spreads, I think, belong in almost every single portfolio, especially if you're new and especially if you have a smaller portfolio. Now, to break this down and understand the strategy, we have to understand a little bit about credit spreads. So whenever we talk about any type of vertical spreads, we have to understand the distance between the two strike prices. So when we're selling the 82 and buying the 77, that's a distance of $5 apart. Now, whenever we're trading a vertical spread, whatever we collect in terms of income, the rest of it becomes our risk. So in this particular case, the distance between the two strike prices are $5. And we're collecting $2.04 out of the $5. What that means is that the remaining portion of the $5, $2.96, that's going to be our total risk. And this relationship between how much income you're collecting versus how much risk you're taking as a function of the distance between the two strikes is an important concept for us to understand that we're going to come back to, because this is really important for you to understand how you find credit spreads that give you an edge and allow you to potentially outperform the overall markets. So In this particular case, we sold the 82.77 put spread. We're collecting $2.04, which means our potential reward is $204 per contract, and our potential risk is $296 per contract. So let's take a look at how this plays out. So in this particular example, like I said, Alibaba has been trading sideways, started to break out higher here. It's trending higher. Now we sell this bullish credit spread. So once you sell a credit spread, three things can happen. The stock can move higher, it can move sideways, or it can move lower. So one of the beauties of selling credit spreads, and this is why it has a high probability of profit, is that if the stock goes in the direction you expect it to, meaning if the stock continues moving higher, you're going to make the full $204 profit. But even if the stock doesn't go anywhere, meaning even if the stock just stays put, doesn't go anywhere at expiration, it's still at 82.68, guess what? You still make the full $204 in profit. That's the kind of the high probability of success nature of this strategy, is that if the direction you get is correct, you make money. But even if the stock doesn't move, you still make the full profits on that specific trade. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. So now, like I said, the stock can go in the direction you expect it to. It can move sideways. It can move against you. So let's talk a little bit about what if the stock starts to move against you. So it's trading at 82.5 right now. What if by expiration the stock is around $80? Well, guess what? That's really the true forgiving nature of this strategy, because even if the stock goes in the opposite direction you expect it to, as long as it stays above your break-even price, which is the $82 minus the $2.04 of credit that you received, that comes out to be $79.96. As long as the stock stays above $79.96, you're still going to be able to turn a profit on this trade. So even if the trade goes against you, as long as it stays above that break-even price, you turn a profit. That's the true forgiving nature of this strategy. Of selling options, that when the stock goes against you, as long as you are within that margin of safety, which is the premium that you collect, you're going to be able to be profitable on this trade. And we're going to talk a little bit about that relationship between how much you can make versus how much you can potentially lose. That's going to help you find that edge for this specific strategy. Now, if the stock declines below that $79.96, but it stays above the lower strike price of $77, that's when you start to see losses for this trade. That's effectively when the strategy that you've laid out is not going in the direction you expect it to, and you will start sustaining losses on this particular trade. The closer you are to $79.96 when it ends up at expiration, the closer you're going to be to zero, and the closer you're to $77 strike price is when you're going to be closer to that $296 worth of losses. And only if the stock declines below the $77 lower strike price, that is when you have the full loss potential of $296 per contract in this particular case. So as you see, in many different scenarios, two out of the three scenarios, you're going to be profitable on this trade, and only one out of the three scenarios, you're going to be unprofitable. And even in that one out of three scenarios, there are some scenarios where you will actually still turn a small profits or only have a small loss on this specific trade. But it's important to understand that when you have a high probability of profit trade like this, you're always going to have what we call negative risk to reward, meaning what you can potentially lose is always going to be more than what you can potentially make. That's the trade-off that you have with any high probability of success strategy like you do here with credit spreads. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about optimal credit spreads. And we're going to come back to this specific example. So whenever you have a stock, just like Alibaba, where you see that it's trending in one direction or another, and you're thinking to yourself, maybe I can sell a credit spread, how do you actually go about constructing that credit spread? Well, this is really where we've done a lot of back testing. We've tried different expiration dates, different strike price combinations to try to understand where can you get the best risk reward ratio and best outcome for these types of trades. And this is really where we find, based on our back testing across hundreds of thousands of trades, is that your target expiration date is roughly about 45 days to expiration. You want to go out close to about 45 days to expiration when you're trading these types of strategies. And what you always want to do is sell an at-the-money call or put. If you're bullish, you're selling puts. If you're bearish, you're selling calls, right? So you always want to sell the at the money call or put. And then what you want to do to offset that risk of selling that at the money call or put is you want to buy a call or put that's roughly 25 deltas. That's the strike price where the stock has a 25% chance the stock is going to exceed that strike that you're buying. So when we bought that $77 strike price, we specifically bought the strike price where there was a 25% chance that BABA was going to be below $77 at expiration. And when you use this type of approach, you're going to get a very consistent outcome of these types of strategies in terms of probability of success. But however, when we did this type of backtesting, what you're going to find is depending on the strategy that you look at selling this specific structure of credit spreads on, some credit spreads you're going to collect a third of the premium in terms of the width. Some you're going to collect a little bit more, some you're going to collect a little bit less. So the rule of thumb that we have with this is that even if you follow these two rules to selecting expiration dates and strike prices to the T, there's still one more rule that you must abide by, which is that the credit spread that you collect must collect at least 1/3 or 33% of the vertical width in terms of income, right? So before we talked about the fact that the vertical width is important because whatever you collect in income, the rest of it is going to be your risk. And that relationship of how much you're making versus how much you're risking is incredibly important. What we're saying is that you need to collect at least 1/3, meaning your risk cannot exceed more than 2/3 of the vertical risk, of the vertical width. If you're collecting less than 1/3, that means you're going to be risking a larger percentage of the vertical width, and that's when things start to go south. And we're going to go through an example here to help you understand why this is so important, okay? So let's say in this example, I sell the $82 put and I buy the $77 put. That's a distance of $5 between these two strike prices. $5. So if I was to collect 33% of the vertical width on a $5 wide credit spread, that means in this particular instance, I'm going to collect $1.66 out of the $5. Now, if I collect $1.66 on a $5 wide credit spread, that means the remaining amount on this credit spread is going to be my total risk, $3.34. If I could potentially make $1.66 and risking $3.34, that's a risk-reward ratio of 2 to 1. For every $2 for every $1 I can potentially make, I'm risking $2 on the back of that. Now, when you have a risk-reward ratio of 2 to 1, you need 67% of your trades in order to be winners. What that means is that if you have 2 winning trades where you win $1, and you have 1 winning trade where you lose $2, you have 2 winning trades where you win $1, 1 losing trade when you lose $2, and you continue this trend on going on forward. What do you get as a result of it? If anyone wants to chime into the chat window, feel free to do so. What do you get at the end of this series? Anthony was, I think, the first one to chime in, and he's right, a big fat 0. Most of you have chimed in. And a lot of traders will ask, why would I ever trade a strategy where my expected outcome is a big fat 0? And this is really why I say this is the absolute bare minimum that you need to shoot for when you're selling a credit spread. If you are selling credit spreads where you're collecting less than 1/3 of the vertical width, it's incredibly difficult to be a profitable trader, meaning your expected outcome in that particular example is going to be negative, and it's incredibly difficult, meaning you have to get the directional view exceptionally well in order to be profitable if you are collecting credit spreads less than 1/3 of the vertical width. And like I said, this is the bare minimum. And when I say this is the bare minimum, the reason that we say this is the bare minimum because this gets you to break even. Most traders are not at break even. Most traders are still losing money on their strategies. So the first goal that I have with these types of strategies is to make sure that we, at the very least, get you to break even. Once we get you to break even, then we can talk about how to turn you into a profitable trader. And that's really where we talk about understanding the edge. Because in the example that I showed you here in Alibaba, when we sold the $82 put, bought the $77 put, we didn't just collect $1.66, we collected $2.04, which means that for every $2 that I can potentially make, I'm risking on the back of that $2.96. that gives me a risk to reward ratio of about 1.5 to 1. That gives me, if I have two winning trades where I win $1, one losing trade where I lose $1.50, two winning trades where I win $1, one losing trade where I lose $1.50. Now I can potentially be a profitable trader and have a positive expected outcome. And this is really what we're shooting for when we're selling credit spreads. Is we're selling credit. We want to find credit spreads where we're collecting more than 1/3 of the vertical width. And now here's the thing: is that this is the first part of finding an edge with this specific strategy, because there's the options trade of side of things where you can potentially find an edge, and it's just about collecting more than 1/3 of the vertical width. But there's the second part that you can find an edge with this strategy as well, which is your timing. Meaning, if you look at this chart here, doesn't matter what this chart is, but this is a chart of a stock that was trending higher. And like I said, whenever you identify a stock that's trending one way or another, that is an opportunity to potentially sell a credit spread. In this particular case, a bullish credit spread. Now, you could have sold credit spreads at any point in this roughly 1-year time frame when the stock was trending higher, and you largely would have been profitable selling credit spreads at just about any point because of the forgiving nature of this strategy. However, that doesn't mean that there aren't good times and bad times from a timing perspective to sell credit spreads. What do I mean by that? So like I said, you could have sold credit spreads at any point on this 1-year time frame, and you would have largely been profitable. But if you sold credit spreads, let's say up here, right, as the stock made a new recent high, so prior to that, this was the highs, and maybe let's say the stock made a new high, and you said, we started a new trend, let me sell a credit spread. Let's just say you sold the credit spread at what I would consider a suboptimal time, which is right here, where I've highlighted on your screen. Would you have been profitable by selling a credit spread? The short answer to your question is yes, but you would have had to sit through some chop. You would have had to sit through some pain for probably a few weeks before the stock eventually got back above your strike price that you sold and turned out to be a profitable trade. So you would have been profitable, but it would have taken you quite a bit of time, and you would have had to sit through some pain, some unrealized losses in order to get to the other side of that profitable trade. Same thing here. If let's say you sold their credit spread here, would you have been profitable after some pain? Yes, you would have been profitable, but sometimes people have really a tough time sitting through that pain. And there were multiple instances, right, where the stock looked like it was making new highs, where if you sold them at kind of what I would consider the worst possible time, like the parts that I've highlighted, you would have been profitable within just a few weeks' time. But like I said, you would have had to sit there for a few weeks, and you would have to suffer through some pain. On the flip side, if let's say you were patient, meaning once you've identified a bullish trend and you waited for pullbacks in that bullish trend, those are your kind of optimal times to enter the trade from a timing perspective. So let's say you enter the bullish trend here. Well, guess what? You would have been profitable within just a few days, and you wouldn't have to sit through as much pain, and you would have been in the trade for a much shorter amount of time and would have been able to take profits much, much quicker. So that's really kind of where, when you're looking for these types of trades, not only do you want to find trades that give you that edge from an options trading perspective where you're collecting more than 1/3 of the vertical width, you also want to try to layer in some technical analysis, some timing, because that can significantly reduce the amount of time that you're in the trade and reduce the pain that you have to potentially experience to get to the other side of that profitable trade. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. So the technical timing and the options trade piece, those are the two pieces that you need to master in order to truly utilize this strategy to consistently grow your accounts using credit spreads. And it's the same thing for bearish trades. You can do this for bullish and bearish markets. That's the beauty of this specific strategy, is that no matter whether you believe the markets are heading higher or lower, you can find opportunities to trade that. Just for a bearish trade, obviously the opposite. On a bearish entry, you want to look for rallies. Rallies are kind of your best opportunities from a timing and from a risk to reward perspective to be in a trade and be able to exit that trade fairly quickly at a profit and not have to sit through as much pain. So we've learned about the strategy. We learned fundamentally how we can potentially find an edge. We learned about timing and why that's so important in terms of trading and finding an edge. It begs the question, how can you find trades just like Alibaba, like I did as an example, on a daily basis, consistently and easily? Well, this is really where the options play tool has automated every single step that I just showed you here today. There are three things that we look for on our credit spread opportunity report. Number one, we only scan for credit spreads that collect a minimum of 33% of the vertical width. But many times we actually find credit spreads that are 40, 41, 42% of the vertical width in some of our trades. So first thing, what we want to do is we want to find credit spreads where you have a risk to reward ratio that's skewed in your favor. Number two, what we want to also do is we want to only scan for very liquid symbols, meaning stocks that you will be able to execute your options trade on at the midpoint or within just a couple of pennies off that midpoint. We do not want to scan for stocks that are not very liquid. And number three, what we're trying to do is find stocks that from a timing perspective aligns with your the bullish or bearish view. Meaning, if you're looking at bullish opportunities, we're looking at stocks that are pulling back, meaning pulling back within a bullish trend. Or if you're looking for bearish opportunities, looking for some of those rallies in order to get access to those types of opportunities. And this is really where the options play tool automates everything, every step for you. So when you go to your ideas, section on your options play platform, underneath the idea section, there's a drop-down menu for specific types of ideas. And we have a drop-down menu specific for credit spread. And when you choose ideas under credit spreads, what you're going to get is a list of credit spread opportunities that are sorted based on the premium versus width, meaning which strategies give you the best risk to reward ratio. I always start my way at the top of that list and work my way down. And generally, you're going to find plenty of trades in that 40% range. So 33 is the minimum that we want to collect. But usually at the top of the list, there's at least a few that are collecting close to about 40% of the vertical width. And that's really where I spend most of my time looking at those types of opportunities. And if there are none, I walk away and I come back another day to trade. But this is really where I find some of the best trading setups from a credit spread perspective. So I'll just show you that here on the Options Play platform. So you go to the ideas section of your platform, and then right underneath, we have technical ideas, cover call ideas, short put ideas, and we also have credit spread ideas. So the credit spread ideas will give you these trades that have done all of the work and automated everything that I've just taught you here today. Like I said, it looks for credit spreads that collect more than 33% of the width, but what I'm really looking for are the ones that are in the 40s. As you can see, these are all the ones that are kind of in that 40% range. These have already been scanned for liquidity, so these are all very liquid symbols. And number three, they have a technical alignment on waiting for that pullback on bullish trades and waiting for that rally on bearish trades. So let's just take a look at some of these ideas. Let's take a look at Futu, for example. As you can see, what I'm looking for are stocks that are in a bullish trend, but have recently pulled back a little bit in that bullish trend. And this is really where you're looking for pullbacks that have the opportunity for this to continue moving higher very, very quickly. Now, as you can see at the time, we're trading at around 73.80 at the time. So what we're doing is we're selling the $73 put, buying the $67 put. So all of this has been automated for you. It scans for the opportunity. It constructs the credit spread for you. So you have all of the risk reward metrics here that you can quickly gauge whether this is the right strategy for you. And if it is, you can simply click on the trade button. If you have a TradeStation account, you can execute that directly into your TradeStation account. If you don't, you can actually set a paper trading portfolio. If you like, if you're brand new to these types of strategies, create a paper trading portfolio, paper trade these in OptionsPlay and track it in your portfolio here at OptionsPlay. Or you can simply enter this trade into your broker's platform as a single strategy and execute this trade as a credit spread where we give you those details so that you can enter those trades into your broker's platform. But this basically automates everything that I showed you here. So in a single click, you can basically validate an idea, meaning look at the chart, make sure that the chart aligns with what your expectations are. SLV, just like gold recently broke out here, it pulled back to this 27.55 level. Maybe this is a buying opportunity. So what it does is it sells the $27.50 put option, which is the at the money put option, buys the $26 put, which is the 25 delta, closest to 25 delta. And in this particular case, you're collecting $62 and potentially making 62 to risk 88. That's a risk reward ratio that's quite favorable, right? That's a risk reward ratio that's actually better than 1.5 to 1. And you have a high probability of profit in this particular case, close to 60%. You look at the chart, if it, it's broken out to a new high, it's pulled back. This is a good potential opportunity to get into that specific trade, and the trade is already structured for you. And you can click on the trade button, and you have multiple places to execute this trade, either into your broker's platform. If you have a TradeStation account, like I said, you can connect that TradeStation account and execute that trade directly into your TradeStation account, or you can set up a paper trading portfolio if you're brand new and you want to test out these types of strategies and track it using our portfolio tool, which you will also find here on the upper right-hand corner. So you can construct any type of portfolio here and track it using OptionsPlay. I saw a question about, where is Delta? So, if you wanted to do the audit here, you can go to modify. You can select the 20, you can select the strike drop down. As you can see, the 26 strike price has a delta of 0.23. That's a strike price that's closest to that 25 delta. So that's why we've automated all of this for you. We've sold the at-the-money strike, bought the 25 deltas for you, and constructed it for you. So you have everything that you need in order to make that trading decision all in a single click. Here's another one on Restoration Hardware. Here's Celsius Holdings. Let's take a look at Celsius Holdings. If you guys like kind of the AI play, Celsius Holdings, as you can see, recently moved higher here, pulled back to this $91 level. Perhaps you think that is an opportunity to break out here. The one thing I look at Celsius is that it's forming this double top here. So just from my perspective, I like to see stocks that have already broken out and started that new trend. But, it has been trending higher here over the past month or so. So this is kind of the last step that you can do a little bit more research on your end as to whether this suits you. But this certainly could be a potential trade here as well. Zscaler, another kind of AI related play here. This is a stock that it hasn't really moved much higher here, but it's trying to move it sideways. It's starting to move a little bit higher. As you can see, it's making higher lows. This is an opportunity to potentially play that upward trajectory here that it's kind of making. As you can see, the trend quality is starting to improve after what has been a very, very poor trend quality. As you can see, the 1 month trend is starting to turn slightly green, slightly positive, perhaps the early stages of a move higher here. This is a little bit more speculative. As you can see, the trend is just starting to barely turn positive. So depending on what you're comfortable with, whether you'd like to be a very strict trend follower or you like to be a little bit more counter trend, you're going to be able to find all different types of ideas that this platform scans for you and find the right one that suits your risk tolerance. But like I said, you don't have to do any of the research, screening for stocks, pulling up options chains to figure out what the right credit spread is. It does all of the work for you in a single click. You click on the button, it gives you the chart, look at the chart, look at the option strategy, and you'll be able to see your risk reward ratio and quickly determine whether it's a strategy that's right for you. Okay, with that covers what I wanted to share with you here today. Before we open this up for Q&A, let's talk a little bit about management of these types of strategies. So I saw a couple of questions while I was on asking about, how do I manage these types of trades? Especially, about early assignment risk. So let's talk a little bit about that, because whenever you sell a credit spread, there are 3 rules for managing a credit spread, meaning 3 potential triggers to exit this trade. And whichever one triggers first, you must exit the credit spread. And that's going to help you stay disciplined in terms of profit, in terms of losses, and to help you avoid early assignment. So the rule of thumb here is that once you lose 100% of the premium that you've collected, that is a good time to exit the trade at a loss. If you've made half of the potential profits on the trade, that is also a potential opportunity to get out at a profit. And the third rule is that if you reach 21 days to expiration and you have not reached your stop loss or take profit targets yet, it is also a time to close out your credit spread. And that last rule is specifically to help avoid that early assignment. You do not want to hold the credit spread into expiration, because you do have early assignment risk, you have assignment risk at expiration, and you have gamma risk that is substantial as you get closer and closer to expiration. You want to avoid all three of those things, and you can do that by sticking to one of these 3 rules. So, for example, if you collect, let's say, $8 on a credit spread, Once that $8 credit spread is now worth only $4, that means you've made half of the maximum profit on the specific trade. Those are some opportunities to start taking profits on this trade. On the flip side, if you collected $8 on a specific trade, and that credit spread is now trading at $16, that means you've lost $8 on the specific trade, meaning 100% of the premium that you collected. You must cut your losses at that point. You do not want to continue holding on to a credit spread. You've lost more than 100% of the premium that you've sold. And lastly, if you reach 21 days to expiration without triggering a stop loss or a take profit rule, those are your opportunities to get out of the trade, whether it's a winner or a loser, because you want to avoid that early assignment risk that will become elevated as you get closer and closer to expiration. Better roll that credit spread to a new 45-day strategy if you haven't hit your take profit or stop loss level and you want to continue being in that trade rather than holding that trade into that last 3 weeks prior to expiration. Okay, so with that, before we open this up for Q&A, just a reminder, in order to use this OptionsPlay platform to generate consistent income, sign up at optionsplay.com/signup or point your phone to that QR code on your screen in order to access the free trial of the platform that I just walked you through here today that finds and automates the full credit spread workflow that I walked you through here today, completely free of charge during that free 30-day trial. And after that, if you choose to go with a membership, like I said, thank you so much for your support for those of you that are members. So let's open this up for Q&A here. There's a Q&A section and a chat window at the bottom of your screen. If you could type your questions in the Q&A window, I'll try to answer as many questions as possible before I sign off during today's session. How do you choose when to do bullish credit spreads and when to do bearish credit spreads? I would say that kind of you have to look at kind of a macro perspective, right? So, one of the things that you can do is you can take a look at, on the OptionsPlay platform, you can pull up SPY, or any of the major market indices. We have our 1 month and 6 month trend indicator. That's going to help you understand kind of what the short-term and long-term trends are. I definitely think the 1 month trend is going to be more useful for your credit spread trading, because you're not in those trades for more than a month at a time. And obviously, you have to apply some general outlooks, right? So right now, for those of you that follow, the other thing that you can do is join me on our Monday morning macro outlook sessions. That's when I do provide you with my macro outlook view of where I think equity markets are headed. And we use that many times to help determine whether we're leaning towards more bullish or more bearish strategies. As of today, I certainly think that we lean a little bit more towards the bearish side of things. We saw the reaction here to equity markets on the back of changes in terms of Fed expectations. We basically printed a new high in terms of all-time highs in equities, but did not print a new high in terms of momentum. So there were signs of exhaustion here on those new all-time highs. And if you look at what sectors were leading the markets into these all-time highs, it was utilities, it was staples, it was healthcare. Those are defensive sectors. Those are not the sectors that you typically want to see leading the markets into new all-time highs. You want to see technology, discretionary, materials, industrials, those types of sectors leading the markets higher, but those are the sectors that are falling behind and continuing to fall further behind. So when you have all of those dynamics in place, my opinion, which is what I laid out during my Monday morning macro outlook session this week, was that we lean a little bit more bearish this week. So if you want to keep updated on kind of our views on the broader markets, join us on those Monday morning macro outlook sessions, which are available to anyone who has a free trial or a membership. We send you a full chart book every single Monday morning with kind of the research for the week. And I walk you through that research every single Monday morning so that you understand how I'm thinking about the broader markets. Hope that answered your question. I've noticed that sometimes the recommended options play spreads will have an upper strike price below the current stock price. So, these are generated once every hour. Now, generally speaking, I think that you will find credits, strike prices that are within very close to the current price of the stock. So, for example, Able Mar trading at 122, we're sold at 122. Asana trading at 1474, we sold a 14 strike. Futu 73, we sold a 73 strike. So, you can quickly audit this. Occasionally, you have a stock that moves so much in the last like 30 minutes that the strike prices that we sold, do not no longer align. So, those ones you probably want to move on, meaning it's no longer valid. But as you can see, almost all of these, we're almost always within, just like well within 1% of the current stock that we're selling. So Celsius 91, we sold the 91, Zscaler 171, we sold the 170s. So, even in today's fast moving market, as you can see, so here's a good one. 97, we sold the 99, right? So I'm sorry, no, we sold the 98, which is correct. The first out of the money strike price, because this is a bearish call spread. So we sold the 98. So that's still correct. So as you can see, it's not very often that you're going to find one where the current price and the short strike that we sold is out of whack. But these are regenerated once an hour, and sometimes in a really fast moving market, you could find opportunities where the trade is just no longer valid. And for those, you just want to move on. My broker does allow only cover calls, buy puts. Is that sufficient for the strategy? No. You need to have level 3, which is trading spreads, in order to trade the strategy. Is there margin requirements for credit spreads? Yes. So the maximum risk on any credit spread is your margin requirement. So if you're looking at, I'm just picking any random one right now. I'm looking at FXF, which is the currency ETF for the Swiss franc. So whatever your max risk is on a strategy, on a credit spread, that's going to be your margin requirement. So in this particular case, that would be $63 per contract to sell this FXF call credit spread. There's a question about NVIDIA. I'm going to pass on that. I'll come back to that, just because that's not really relevant to this educational strategy. That's really relevant more so to our Monday morning macro outlook session. I'll certainly cover NVIDIA during our next Monday macro outlook session. Do you have to indicate to OptionsPlay whether you're bullish or bearish to credit spreads from that platform? No, you don't, but you can sort and filter by only looking at bullish credit spreads or bearish credit spreads. And certainly bullish credit spreads have a further edge, right? Because markets move higher 60% of the time, move lower 40% of the time. So, I do have traders, especially beginners, who will say, I only like to sell bullish credit spreads. I don't like to sell bearish credit spreads because I'm not as comfortable with timing on bearish trades. So you can easily just filter out all of the bearish trades and only look at the bullish trades using the sort and filter function here within your credit spread section on OptionsPlay. Where can I find the recording and slides? So we post this onto our YouTube channel at youtube.com/OptionsPlay. But if you have a free trial or a membership, we will also send you an email update once those recordings are posted onto YouTube, and we'll also send you the slides as well in that email. I see sometimes the expected return is negative, and most of the time it's positive. Not sure I understand what you mean by that, Lucius. If you don't mind clarifying, that'd be helpful. When to roll up or roll down. So if you hit 21 days to expiration, meaning you sold something that's 45 days to expiration and now it's approaching 21 days to expiration and it has not reached your take profit or stop loss, that's usually when you want to roll. And generally speaking, you only want to roll profitable trades. When something's not profitable, I don't think it's a suitable roll. I think you should just move on and find a new security to trade. So rolling is really for when the trade is going in the direction you expect it to and you think it's going to continue, then you roll up or down. And then if it reaches 21 days to expiration and it has not reached your take profit or stop loss level, you think that you just need a little bit more time, that's who you want to roll as well. You don't generally want to roll losing trades. Infidelity on E-Trade, there's no place to put stop loss. How can we manage risk? That's tough. I recommend trading on platforms that do allow you to put a stop loss order on a vertical spread. I use Thinkorswim, which actually lets you put bracket orders, meaning I can put a limit order and a stop loss order. So I'm kind of protected on both sides and I don't have to monitor the positions on both sides. Yeah, it's hard to trade these strategies if you're not, looking at your accounts every single day if you can't place a stop loss. If you can't place a stop loss, I would say then you have to log in at least once a day to look at your positions, preferably, maybe 2-3 o'clock before the close, giving you plenty of time to react, if you are close to take profit or close to stop loss. What is the minimum trading account recommended to trade credit spreads? Minimum is $2,000 because you need a margin account. However, I do think closer to 5,000 is a better starting point for most traders trading this type of strategy. Should we only select trades when the options play score is greater than 100? No, not necessarily. Anything that's at least 80 is sufficient for selling credit spreads. You just want to avoid anything that's less than 80 for selling credit spreads. Would you recommend selling cover calls in a stock that continues to drift lower? So that's a really good question. The short answer to your question is, do you still believe in the bullish thesis of the stock, right? You own a stock because you believe in the long-term prospects of that stock. And the question is, do you still believe in the long-term prospects of that stock? So it really should be contingent upon that as to whether you still continue to sell cover calls. If you still believe in the stock, then you can continue to sell cover calls. If you no longer believe in the stock, you should not be owning that stock at all. You should be getting out of that trade and basically rolling your capital into another trade. With that, that covers what I have time for questions during today's session. Thank you so much for your time. I really appreciate everyone taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of why this is the one strategy that I believe everyone should have in their portfolios if you're interested in generating income consistently and growing your account. With that, thank you so much. Have a great trading day, and I'll see you guys here next Monday on our Monday morning macro outlook session.